All right. Okay, so let's talk about fraud risk assessment. So I'm going to start this off by basically saying the auditor's job is not to find fraud. The auditor conducts an audit of the financial statement. So it's a financial statement audit. What the standards speak to about fraud is risk assessment, right? So that's why it's a part of our discussion as we talk about the planning process. Auditors have to examine, assess the risk of fraud, what factors exist, such as what we call red flags or fraud risk factors, exist that would result or suggest that there is a higher risk of fraud, and and what accounts would the auditors focus on to identify that. So it doesn't mean that there is fraud, and just as we spoke with the risk assessment process with the audit risk model, right, the auditor is going to design their audit procedures to address that risk. It's the same thing with the fraud risk assessment. It's identifying where the financial statements are susceptible to fraud, right? And then design their audit procedures to obviously to address that risk that they assess with respect to fraud risk. So we're not conducting a fraud audit. It's possible that the auditors could assess the risk of fraud and still not find a fraud, right? So it's not meant to detect fraud. So, which is a common misconception amongst users of financial statements, people who are less knowledgeable and think that auditors, that's one of the expectations, the gap in expectations, that people think that auditors conduct the audit to find fraud. So when we talk about fraud, right, it's intentional misstatement, right, or misrepresentation, I should say. So fraud consists of knowingly making a material misrepresentation of the fact with the intent of inducing someone to believe that a falsehood and an act upon it and thus suffer loss or damage, basically, right? So there's intent. Knowingly, intentional, that's what you set out to do. You don't accidentally commit a fraud. So there are two types that we're going to talk about. I know the text goes into several different types of fraud, but we're going to focus primarily on fraudulent financial reporting and misappropriation of assets. So you will oftentimes hear fraudulent financial reporting referred to as management fraud, right? And then misappropriation of assets is employee fraud. But that, management can steal assets as well. But for our purposes, in talking about fraudulent financial reporting, it's usually going to involve those individuals who have obviously some level of control over financial reporting process. So it will usually entail people who are more senior in the organization. And we'll talk about some of the fraud risk factors associated with that. So fraudulent financial reporting, sometimes you hear how people manage earnings. Right? Well, if you're managing earnings, there means there's this intent. Like if you're using the subjectivity and gap, right, to report more favorably for the company, even though you don't think that the numbers are actually what they say. You're being optimistic. So remember the case, even though this is a little similar, not exactly alike, but remember when we were talking about, we did the ethical vignettes, and there was one case where the manager had to decide whether they take the optimistic view or they take the more pessimistic view. And we went back and forth about, people had different, different versions or opinions about what management should do. Well, if you have a situation where management knowingly, their intention is to deceive, right? That they, by taking that more optimistic view, their intention was they had the intent to deceive the users or misrepresent the facts. That's fraudulent. There's an intent to misrepresent. So we define fraudulent financial reporting as a special case of risk material misstatement. in those situations where management intends to mislead the marketplace by issuing fraudulent financial statements. The key difference here is its intent. You can have an error, but if you intend to mislead, then it's a fraudulent, it's fraud. Misappropriation of assets is when someone steals an asset, cash, inventory. Right? So they steal the money, it's not theirs, right? Or they steal the inventory, and it usually consists of the fraudulent act, which is the debt, the conversion of the money and property for their own use. So they steal it and they use it to do whatever they're going to do. Take a vacation in a Fiji island, buy a new Tesla, right? But they use it for their own purposes, and then they cover it up. Right? So those are the three elements of it. So those, the two areas are for misappropriation of assets and fraudulent financial reporting. Of those two, what do you think is hardest to uncover? Yes.
The second one?
Misappropriation of assets.
Misappropriation.
Why? Why do you think that's hard?
Because in fraudulent financial reports, you at least have reports that you could look at and speculate at, while property can really just be under a lot of other people's names and can get very convoluted pretty quickly.
So I would suggest, right, that they're both hard, right? Because what's the key with, you could look, right, because you're auditing, right? And you could look at reports and stuff, but usually when people are reporting fraudulently, they're reporting within the bounds, right? They're a gap, or at least they're trying to report in those accounts where it would be more difficult to detect, right? Because so there's judgment involved. Right? The key is, remember that is intent, right? And how do we know what intent is? How can you say with certainty that management intended to defraud? Right? That would entail getting behind the black box, right? So fraud is difficult to detect. Because, and that's why, we only know about the frauds that have been found. Or we don't know about frauds that are, we can't predict when a fraud is going to occur. Even though someone was telling me that using artificial intelligence, like there's now artificial intelligence technology out there that can predict when employees that are likely to commit fraud. So I don't know how far along this is, but I was at a task force meeting with PCOB, and one of the people that talked about the use of artificial intelligence to do things like that, to predict those employees who are more likely to commit fraud.
I have a quick question. So for the assets one, though, you said that it has to be material, right? So we still have to determine some material.
No, I didn't see anything about
okay.
materiality.
Okay, but
fraud is if you stealing, right? The problem is, so from an audit perspective, right? If the auditor uncovers a situation where they suspect fraud, they're not going to look at it and say, "Oh, but it's only $10,"
okay.
Because you don't know that.
Yeah.
Right.
Okay.
So materiality kind of goes out for it.
Okay.
All right. So fraud is very difficult to detect. So as a result, most auditors are never really exposed to it, where they've uncovered fraud. What does the standard say? The auditing standards, remember I talked about the fact that when we talked about professional skepticism, there's no one standard that says there's the professional skepticism standard. Instead, this idea of professional skepticism or concept of professional skepticism is kind of woven throughout the standards. Right? And so statement on auditing standards number 1 talks about auditors having a question in mind. That's really what that says. Trust but verify. You can't assume that management is completely honest, but nor should you assume that they're completely dishonest either. So you have to be skeptical. Trust but verify, have a question in mind. The PCOB standards that talks about the auditor's responsibility with respect to fraud in the financial statements is PCAOB standard or AS standard 2401. And then the Auditing Standards Board, Statement on Auditing Standards, is SAS 99. So for quite some time, SAS 99 was the prevailing standard that provided guidance to auditors in assessing the risk of fraud. But again, the PCAOB has recently issued a standard, which is 2401. That covers the auditor's responsibility. The key thing here is they talk about assessing risk, the auditor's responsibility with respect to the assessment, fraud risk assessment process, and how they should respond to that risk. So it provides them, both standards provide auditors with guidance. So let's talk about some of the fraud risk factors, because that's how auditors are going to assess risk, is look at the risk factors, and how do you think the auditors identify these risk factors? What point in the planning process are they collecting this information? Yes.
Is it in the planning?
Right, but at what exact, because this is a part of the planning process as well, but what area of the planning process?
In like the brainstorming area?
Right, so SAS 99 talks about brainstorming, but what they're brainstorming is information that they found, right? So they have to go out and they have to gather information. So what is one of the things that we talked about in the information gathering phase?
Would it be when they determine significant risks? Like they take that into account?
Right, but how do they determine significant risk? What is it the action that they're doing that's going to help them determine significant risk?
They create an audit book?
Well, they're going to create the audit plan after they identify the risk, right?
They use analytical procedures.
And where is it, where did we talk about them using analytical procedure? That's one thing that they do, right? Remember the client accept.
Oh, they.
Right, they have to understand their client, right? Understanding the entity, right? Identifying the client's, the business risk. Remember, they have to identify, well, here's the client's business risk, and how might that business risk impact the financial statements? How might it manifest? Where are the financial statements, right? So as the auditors understanding their client, understanding the business risk, understanding the entity, they're gathering information. These are the kinds of things that they're gathering. When they're going through the risk of material in the statement, assessment of the risk of material in the statement, these are things that they're considering as well, right? Inherent risk. Management has a motivation, right? Bonus compensation, stock options, right? So the auditor's like, that's inherent risk. That's going to increase the inherent risk, right? Because those are factors in the client's environment that could lead to a risk of material misstatement, a material misstatement in the financial statement, right? So these things are all connected, right? So they're gathering that information. So some of the management characteristics and that influence fraud risk factors, and so I want to say this, make this clear. It's not like, oh, management has, stock options, so therefore they're probably committing fraud. No? Or therefore there's a high risk of fraud. No, you're going to consider maybe management has stock options and there's a poor tone at the top, right? That there's management has a very aggressive attitude toward reporting. So you're going to consider it in the context of other factors as well. That there's controls, management continuously overrides internal controls, right? So then that makes that, the fact that compensation is tied to performance, firm performance, even more risky, a higher risk. So you're going to consider these things in the context. But some things, as I said, are motivation. That creates motivation is if their compensation is tied to performance. If it's dominated by one or a small group of individuals, they don't have the tone at the top about internal controls is not very effective, right? They just don't take it very seriously, don't enforce it, don't really monitor it. They have very aggressive attitude toward financial reporting. So let's say, for example, estimates, right? If they're always pushing the envelope to when they evaluate their estimates or develop their estimates, do they tend to be more aggressive? So for example, with obsolescence, or aggressive from a management perspective would mean that they're looking to report a lower obsolescence reserve, right? Because that would result in a lower expense, right? And then obviously higher net income. Do they, if they're publicly held and analysts follow them, do they place too much emphasis on meeting earnings projections, meeting analyst forecasts? Are they, I'm just not gonna go through all of them, is there a high turnover rate of senior management? Why is that a fraud risk factor? What do you think? A high turnover of senior management. Why do you think that would result in a high fraud risk? Or a fraud risk factor, I should say. Yes?
Is it because, like, you can, like, blame the person that left? So, like, if you have people leaving, and then all of a sudden this fraud comes out, like...
But let's just say at this point we don't know about fraud, right? Because remember, at this point, the auditors are assessing risk factors.
There's greater opportunity to commit the fraud, because there's less people in oversight to see.
So there's a knowledge turnover, right? You're right. You're right. There's a knowledge, because when that person leaves, that person takes that knowledge with them about the company. Maybe the people who are turning over are people who had a very strong position on internal controls. Shannon, what do you want to say?
I was just gonna say that maybe since they're not there very long, they're not able to notice what's going on. And
Right, so when you have a new person come in, right, they don't know, right? They're not as familiar with the company. Maybe there's a reason that management is leaving. Like it may be, if you have a dominant, like, I don't know, chief executive officer, and they're putting pressure on, senior CFOs, controllers to manage the numbers, and these people don't do it, then they fire them. Are they firing them? So, it doesn't mean that there's fraud, it's just that could be somewhat troublesome. So it's a fraud risk factor. Managers and employees tend to be evasive when responding to auditors' inquiries. Like, again, this would be the auditor having, because sometimes people just don't know the answer, or they're putting you off or whatever. Maybe it's because they're doing something they're not supposed to do, or maybe they just they don't want to audit. So, but the auditor has to use their intuition and their judgment to determine that. Managers engage in frequent disputes with auditors. In other words, they don't ever want to book anything, or when the auditor comes to them about their concerns about estimates or about how things are being reported, that they're always fighting with auditors. Again, that is a risk factor. Are they doing something? Like, are they trying to, or more likely to report, intentionally misreport? So those are management characteristics in industry considered conditions that auditors should consider. So these shouldn't be surprising, right? The company profits lag those of the industry. New requirements are passed that could impact the company's stability or their profitability. They face a lot of competition. They're in an industry that's declining, which would then mean their revenues are declining. The company's industry is changing rapidly, and they're not meeting the pace of change. They're not keeping up with the pace of change. So all those things on their own, again, doesn't mean that the company's committing fraud. But when you compare those factors, let's say with management who's overly concerned about projections, or management who's overly aggressive about financial reporting, or you have the company has a known list of history of violations. When you pair that increases that fraud risk. Then operating characteristics and financial stability, obviously a weak internal control environment. Right? So if you can't remember what we said, if the internal control environment is weak, that means that the internal control, so the auditor perceives the internal control risk to be high, right? Control risk would be high. And that means that the company's system of internal controls are non-effective to prevent or detect a material misstatement. Right? So there might be improper segregation of duties, right? Which will then allow for someone to perpetrate a fraud and cover it up. because the controls are not in place. The company is having cash flow problems, and there's pressure on them to obtain capital. They have a lot of, we talked about the difficulty of measurement, accounting measurement, such as things, fair value measurement for financial instruments that are hard to value, where there's no ready fair value market. That increases the risk. It not only increases the inherent risk, but it increases the risk of fraudulent financial reporting. If the company has significant and unusual related party transactions, I think we all saw that with Enron, right? That was the rise of Enron. Or the companies, the people who are responsible for the accounting and the controls are lax, and there's no, they're not good at what they do. They're lax. They don't, they don't really support the company's position. There's no mechanism in place to ensure that controls are being followed and adhered to along with the company's, control procedures. So these again are just some examples, and which I just took these. When you read through the standards will talk about these are the things that auditors should be mindful of. Not that it means that there's fraud, but these are risk factors that the auditor should consider and then design their audit procedures to address these risk factors. Now, some of these things, you could have, for example, management who's very aggressive, but if the company has a good tone at the top, right, and controls in place, then those the effective internal controls would mitigate the risk associated with management who tends to try to afford more aggressively. So, who is a fraudster? What should the auditor be looking for? So, based on this list, how many in this room would be a fraudster? Right? So what is it, right? Is it you don't know? You can't look at somebody and say, oh, that's fraudster. Oh no, that person goes to church way too often. Because they're in church asking for forgiveness. Right? You don't know. Maybe they just don't judge. Right? You just don't know. You can have people who are rebels, but that doesn't make them a fraudster. Right? So we don't know. So you can't just look at somebody, which is why I would be interested in this AI technology. In fact, Ivy and I, along with Professor Bassarelli, we're actually working on a research project that looks at the ethics of AI technology that does similar things like this, where you're going to track an employee and say, oh, that person looks like they might be a fraudster committing fraud, because then it has an effect, right? It has a rippling effect on how you as the manager or that manager perceives that employee, and now they're looking at that employee side. It's like, oh, who gets a hold of that information? So, it'll be interesting to see how that works. But in any event, right? So the key here is that we don't know. We can't look at someone and determine. So we have to look at things that are a little bit more objective, right? So the fraud risk factors. There is some red flags from an employee perspective. But again, if you go through these red flags, is that you don't have enough sleep? Well, that could be most of us. Especially around, I guarantee around the final exam time, most of you are not sleeping.
Not sleeping now.
But I don't think Shannon's a fraudster. Right? So you don't. So and again, think about this from your perspective as an auditor. Would you even know this? First of all, you are probably sleeping. Right? When you're doing the audit, it's the end of the. You are under time pressure. You're working crazy hours in busy season. you're sleepy, so would you even pick up on the fact that somebody else is sleeping? Right, so I mean, the whole point of this is like, these are things that are going on. Now, a forensic auditor, right, might know these, they might look at something like this and have a totally different perception, right, or come away with a totally different conclusion because they're trained to see particular patterns in people's behavior, things they say, how their eyes move with their hands, and whether they're closed when they're sitting. And so but usually when a forensic auditor goes in, that person has been hired to uncover a fraud. So they're coming in predisposed with this information that there's a fraud has occurred, or there's a high possibility of a fraud because maybe management of the company's hired them to find it out. So they're in a process of verifying. So they're trained differently. They might not even, some of them, might have financial accounting and auditing background, but some of them are law enforcement people from FBI, CIA.
Where can you get training to be a forensic auditor? Like, is that like in a firm?
The firm can do that, but there are also
programs.
programs, right? Educational programs for people.
Jamie has a forensic audit.
Who's that?
Forensic accounting program.
Yeah. Keene, I know a number of schools do. I know University of West Virginia had a big forensic accounting auditing program because they actually got funding, I think, from some governmental institution to do it, to establish it. There's a lot of research coming out. So I know Baylor does forensic. So there's a number.
So do you have to have a degree, or is it just better to like do the degree? Like the program?
I think it depends on where you want to go, and then also like what job would you try to target.
Yeah.
But I think if you wanted to, like, let's say you wanted to do that, you wanted to do forensic auditing, you could probably take some classes, and the firms, and that would be a part of their advisory side of the business necessarily. I think, and you could, say, hey, I want to go into forensic auditing, and I'm sure they do training, because those people the people who are in there are not necessarily auditors. I'm sure that they have some people who came through financial accounting and auditing, but they also have, like as I said, people who are in law enforcement. Right? And when I went to something at PwC many years ago, and they had some people there from their forensic, I forgot what they called the group, but let's just say their forensic accounting group. And the person who conducted it, who was pretty senior in that group, was someone from the FBI. That was how they were trained. That was their background. It was in law enforcement. Because and you think about it, law enforcement training, these are the kinds of things that they are trained to do. They're trained to uncover, to try to ferret out whether someone's being dishonest. What are the signs somebody's lying? Right? And then they observe behavior differently. Because you really do have to, of course, if you're trained in, following evidence, but another part of your training is analyzing behavior of individuals and how to interrogate someone. But all of that to say that some of these things you're not going to know. Some tips come to audit just by being, other people talking, other employees. In my last class, when we talked about this, one of the students, she said in her job, she identified someone, or she had a strong suspicion about someone who that she worked with. I think she said he was in accounts payable. He was in the accounts payable department, and what she noticed was that, wait a minute, his lifestyle didn't seem to fit with his pay grade. And that she noticed that he was always wearing really expensive suits, and he was just living a high life. And so something about him now this person wasn't trained, but she had this suspicion. Long story short, it turned out that this person was committing a fraud. They were embezzling or stealing money from the company through purchase, and so they were doing that. But that was just, again, kind of her suspicion. So you could have, and that's why companies will have hotlines, right? If people suspect, and they rely on that, because a lot of times the person that you work with, when you're working with people, those people are better able to observe certain behaviors because they're around that person on a daily basis. So a lot of these you just really, they're signs of lifestyle but it's not always things that auditors are going to easily be able to pick up. And here are just a few more. This whole idea of working standing up, I had this one always gets me, like, I have no idea what that could be. Maybe it's because you think that if you stand up, you can flee when they come to get you. I have no idea. But, maybe it's a sign of nervousness that you're never sitting down. I don't know. So it's just interesting.
They have the new workstations with.
Right, where people stand, so there goes that one,
I like know a lot of people who do that.
Yeah, so, I mean, but one, where they don't take vacations, there's some, like the financial services industry, you have to take vacations. Right, that's a requirement, the regulatory, that you have to be gone for obviously these are people in senior levels or dealing with financial reporting. But you have to take vacations, and you can't have any contact with the company for those 2 weeks that you're on vacation. And it has to be 2 weeks straight. You can't say, oh, I'm gonna come in this day and then I'll say, no, you have to be gone. Right? The company can't contact you, you don't log on to the company email, none of that stuff. They are very, and it's a part of regulatory requirements, and it's something when they have regulatory audits, they look to determine this. So companies are really, so financial services, the idea with this, that idea is that if you're gone, right, and someone has to replace you, right, they have to do the work, or you have to train somebody or get someone prepared to do what you do. And so the thought is that you'd be able to uncover, like that fraud would be more discoverable if you were committing a fraud that someone, it increases the chances that someone might find out if you're doing something like that. Okay. And then someone pointed out working late frequently. What if you're just a hardworking person? It's true. Could be. But most people really don't. I mean, it could be. But it's wise, if that's the case, if you're working late all the time, you're never getting your work. Because at some point, then you should be so far ahead of where you need to be. You need to come to work, like, right? So, again, so these are all just things that usually point to, but, it's hard to detect from an audit perspective. So I guess what is it? As auditors, you just want to be aware. Right? Sometimes people will talk to you and give you information, or they'll say things and you put that together with other information, and it might point to, okay, there are problems in this area, and I found out that person, is always working at it. So, the fraud triangle, how many of you heard of the fraud triangle? So the fraud triangle is a well-established framework that's used to kind of assess the risk of fraud. And basically what the fraud triangle says is there are three conditions. There's motivation, there's opportunity, and there's rationalization. And when those three things intersect, that creates the highest risk that fraud is occurring or can occur. So motivation deals with, as it says, the incentives. Why are people motivated? So you saw in one of the red flag or risk factors identified is that management's compensation is tied to their the firm's performance, so how well the firm does. So if you are the CFO or the controller, and a big portion of your compensation, right, or material portion of your compensation is tied to meeting analyst forecasts. Well, now you have incentives. You may be motivated to manage the numbers, right, so that you can meet management forecast. Opportunity, right, is things like the environment, the firm environment, the company environment is such that you are able to commit a fraud and it not be detected, or prevented or detected on a timely basis. So, for example, our internal controls lax. If they're weak and ineffective internal controls, then that's going to provide the opportunity to commit a fraud that won't be detected or prevented by the internal controls. Right? If management is lax, if management overrides internal controls, then that creates the opportunity. And then rationalization is your own internal, mechanism for getting comfortable with why you're doing it, right? Making it seem all right. So you could have people who say, oh, this is just to help me get through this tough time, you know, or this is just to help, I have to pay for my spouse's, you know, medical, and we have horrible, the company doesn't provide good medical insurance, so now I'm gonna have to pay, so I have to do this. They should be providing better insurance. Or management gets really high bonuses and, you know, I only get a small increase, salary increase. So is the rationalization of why you're doing something. So basically the framework just says when these three things intersect, there's the highest risk that fraud occurred. So in terms of the auditor's responsibility, the standards said, as I said, assess the risk of fraud. Think about where that fraud might be, how it could be perpetrated, where is it likely to be reflected in the financial statements, and adjust your audit procedures to address that. So auditors would overall change the audit to respond to the identified fraud risk. So it might be, if there's a high risk of fraud, engaging assigning more experienced people to that particular area of the audit, or engaging a fraud specialist. Design and perform your audit procedures to make sure that you address that specific risk. So, for example, if there is a higher fraud risk because management has incentives, they tend to be highly aggressive on estimates. Right? That's how, and they're always fighting the auditor on adjustments to their estimates. Then the auditor would design their audit procedures, or they would look at, spend more time looking at those estimates, gather more evidence, and scrutinize management's inputs and assumptions on those estimates in a lot more detail. Some standard things that auditors should do to address the risk of management override of controls, right? So the company could have effective control activities, but if management overrides those controls, then they're not effective. Right? And so you don't know. So an auditor doesn't know that management overrides the controls necessarily. So some things that they would do would be to examine journal entries and other adjustments. Right? So usually, right now, you know, all firms have the ability to examine 100% of the journal entries, right? To scan the journal entries that are being made to the general ledger and see if there are any unusual journal entries. So for the most part, you know, most of your journal entries you can test as a result of testing internal controls, right? Because your journal entries, so if you think about the journal entries that feed the general ledger, a lot of it will come from your business process, right? So on a monthly basis, you're going to record revenue for the month. That's going to come from your sales journal. So if the auditor knows the controls over that, right, and they're comfortable with the controls over revenue, then they're going to be comfortable with how revenue rolls up to the general ledger. Cash receipts, cash disbursements. So a lot of the journal entries that are going to be reflected should be those journal entries that are coming from other sources, right? There's just a part of your business process, your normal monthly process. So what you want to look for are topside journal entries. So journal entries that are not coming from where you would expect. So if you see you're looking at revenue, you shouldn't have a debit in revenue. Right? The debit to revenue is when you close it out. Why would there be other debits to revenue? So that's what we consider a topside, right? Because revenue should be credits coming from the sales journal. Or if you're looking at, equity accounts. How many journals? You shouldn't see a lot of activity going on in your equity account. Equity kind of is pretty, there's not a whole heck of a lot that goes on with that. Your retained earnings, you're gonna see your retained earnings being impacted, one, by your net income or loss that you report for the year, and any dividends that you pay out. So again, so auditors can look at topside adjustments, right, that don't make sense, right, that's not coming from an established source that they've tested for internal control. And those are the things that you wanna focus on, right, are those types of adjustments. Obviously, reviewing accounting estimates for biases, right, that's just a part of your normal audit approach. You have to gather evidence about estimates, but as we pointed out before, what's unique about estimates is just the fact that you can contain biases because it's based on management's judgments, the inputs they use, the assumptions that they make. And then look at any unusual transactions. So you pretty much, when you understand the client's business, their entity, you know how they generate revenue. Right? You know how they make their normal business transactions that they engage in. So yet now you want to focus, are there any transactions that don't seem to make sense? Right? You want to look at accounts like other income, other expenses, because those are, not a part of your normal operating income, because your normal operating income would be reflected in revenue. So you want to see if there are any changes, any significant transactions flowing through other income or other expenses. So those are just of the ways that auditors to identify, right, where there might be some fraudulent activity. The other thing that I said before, and we'll talk about this more when we talk about revenue, is assume that revenue is high risk. That the standards are really clear on that. Presume that revenue recognition is high risk. Because what is it that people want to do? They want to ensure that they like revenue. It's a key number, a key indicator in any company's operations. We talked about identifying management override of control, and then what are the significant risks? And those other significant risks are things that you're going to identify as you're going through understanding the business, understanding the entity, right? What is management's business risk? And then how likely are they to not meet their objectives? That's their business risk, right? And then how are those risks reflected in the financial statements, if at all? Other things, as the auditor is going through gathering information or evidence, looking for missing documents. A standard audit procedure that auditors perform is the completeness of the books and records. So part of your group project or the analytical mindset case, or also when you're doing IDEA, is to make sure the information you have is complete. Right? That you can't, if you don't know that you have all the information, you can't provide any evidence about the completeness, or know that you audited the population, the correct population. Look for alterations on documents. Right? This is not as, I shouldn't say it's not, but with word processing capabilities now, technology is so much better. It's more difficult to determine if a document has been altered, right? If somebody could duplicate an invoice by scanning it, right, and it looks like a real invoice, right? So it is more difficult, but you look for documents that might have been altered. Photocopy documents, again, same thing. Photocopiers now are so much more advanced than they were years ago, so it's hard to determine if it's actually a copy document, and now you don't even have to just scan it. Right? So usually companies will endorse the checks, and they should. Controllers endorse checks right away, and it's usually endorsed with a company machine or a restrictive endorsement. Normally you don't see more than one endorsement on a check, so you can look for those things. Any unusual endorsements. Old outstanding checks are also assigned, right? Because most people are going to cash their checks right away. unexplained adjustments to accounts receivable and inventory balances, right? Because again, we have inventory obsolescence, allowance without account. So is that some indication of, because again, your accounts receivable, for example, should really, the debits should come because you engaged in a sale, right? So you should see, those debits should really be coming from your sales journal. And the credits are because the company paid, it was paid off. And that's coming from your cash receipts journal, right? So when you start to see adjustments to accounts receivable that don't come from those two, those are what I would call top side adjustments, then the auditor would want to look at that. Any unusual patterns in deposits, general ledgers that do not balance, I mean, come on, that's accounting 101. Debits must equal credits. That's the balance. Any cash shortages or overage and any excessive voids in credit memos, right? Because that might be a way to override a particular an unauthorized journal entry. Another thing is customer complaints. Because what if the customer's complaining, you're billing me, you're getting customer complaints, since you're billing me for a shipment that I never received. What would that suggest to you? If you're the auditor, you get tons of customer complaints. Let's say you get those customer complaints around year end or quarter end, that they're being billed for shipments they never received. What does that sound like? Right, overstatement of revenue. If they didn't receive it, we already said, if the customer never received it, then you can't recognize that revenue. And if you didn't ship, so it could be that, and I might say that, let's say the auditor is gonna look at shipments, right? That if you just know that it left, right? It left the warehouse, so the company was record. How do you know that they didn't ship those goods to some warehouse that's down the block? Right? Because from your, if you just know that the goods left the company, right? So you're gonna report that revenue. But what if they were shipping it to a warehouse? It's their warehouse. The only way you're gonna be able to uncover that subsequently is you're gonna see customer complaints. Because they're building a customer, because that's what they're gonna do, they're gonna build a customer. So you'll see write-offs, or you see returns, a high amount of returns in the next period, or the next couple of periods. Okay? So those are indications that maybe there's some fraudulent financial reporting going on. You see, as I said, increased past due receivables, inventory shortages, right? That means that when you're doing your physical inventory, and the differences are significant between book to actual, maybe, and that doesn't seem like it makes sense that you have that much scrap, right? Then maybe somebody's stealing inventory. Employees that can't be found, phantom employees. Someone was another one of mine. So all my students in this other class all seem to work for companies that had a bunch of fraudsters, right? Because they gave this example. One of my students gave the example about that. He worked for a staff, an employee, a company that staffed employees to different companies. And essentially, there was one manager, like they had regional manager, supervisor, whatever. So there was one manager who insisted that he wanted to collect all the checks. Like he wanted the checks to be handed to him, and then he would give it to his employees. Well, it turned out that this guy had created phantom employees. So, or when he never took them off. I don't know how he did it, but he created these phantom. So he was pocketing the money. So you should, and that's the standard internal control. No, the check goes to the employee. Right? The check goes directly to the employee. But now with direct deposit, you can kind of get around some of this issue. And then things like dormant accounts. And so you're gonna always look to see, wait a minute, this account was dormant, why is it now active? So that's why you're gonna see that companies purge accounts, old customers that haven't, they haven't engaged in a sale with in many periods. Same thing with vendors, right? Because when those accounts are dormant, that's where people can hide fictitious transactions, right? So in terms of the auditors, who they must communicate with. So if the auditor identifies a fraud, like they're not now gonna change this audit over to a forensic audit. They're responsible to communicate, right? They have to communicate that, and management's responsible for taking action on that. What the auditors have to do is assess the impact of that fraud, to the extent possible, on the risk material statement. So auditors, they don't take it, you can't just run around telling, oh, there's a fraudster running loose in place. You want to try to at least find some evidence, strong evidence that a fraud may exist. You communicate it to the appropriate level of management. Any fraud committed by management, no matter how small it is, this is the idea that there's no such thing as an immaterial fraud, should be reported to the audit committee or the board of the board of directors, right? The people who are responsible for governance. So there's no such thing as a small immaterial fraud when management is involved. And obviously you have to document fraud matters, so they have to document their fraud risk assessment, how they arrived at that assessment, what factors drove their decisions around that assessment, and communicate that information to the audit committee. All right, so we're gonna stop here. So for Thursday's class, Thursday class is gonna be all about, working on multiple choice questions. So I'll go over the quiz. There's a case that's in the in-class case folder on Blackboard. There's like 2 very short scenarios. Just read that before class, and we'll work on that in class. And we'll also go through some problems in class. So it'll all going to be very interactive on Thursday. All right, guys, have a good evening.